All right, let's go ahead and get started. Welcome. I'm Dean Jenkins from FollowMeTrades.com, and I'm looking forward to today's webinar. And I'm going to talk about the tools that I use to analyze both the indexes, the broad market, and individual stock charts. You know, I like to say, I titled this on my title page, it says, "The stock market talks." I think the stock market does talk to us. I think it tells a story, and that the price patterns are the only real reality in the market. You know, all the news, all the financial information totally matter, but at the end of the day, it's what investors and traders think about that information and how they respond to it that matters. And the reality is reflected in price on the stock charts. The only realities in the market are really price, what did the thing sell for, and volume, how many of them sold for that price. I just heard, Bennett McDowell's been my mentor for several years, and I just heard him this week, and he said, "Price never lies." That's a great quote. And again, the story that the price patterns tell, I think there's ways to read that. And I'm just going to talk about the tools that I use here to do that. So first, as always, a quick disclaimer. So this presentation is for educational and informational purposes only. I'm not a financial advisor. I don't know your situation. I'm going to show you some trades that I'm in later on, but I'm not making a recommendation for you to buy or sell because I don't know what's appropriate for you. Okay, so just that disclaimer. So let's take a look here at, this is the S&P 500, and this is a monthly chart. And it's looking back in history just a little bit. Okay. So if you remember, most people on this call probably do, the Great Recession of 2007, 8, and into 9. And people who were buy and hold investors just had a huge bite taken out of their accounts, right? It started in October of 2007 was the high, and it ended in March of 2009. And the market went through, at least here on the S&P 500, a 49.38% loss, nearly half. Right? And people that were nearing retirement, they had their plans put on hold. And after this, many people decided just to stay out of the market altogether. Right? They got a little spooked by that. And what I want to teach is there's really no reason to sit through that, right? Ouch, there's the shark, right? That's a big bite. If you just sat through that, right? And individual stocks could have lost even more than that, nearly 50%. And then, for people that got scared out and stayed out of the market, this was an even bigger bite. It would be because the market came back. And from that March 2000 low, I put this presentation together early last summer, right? And the high at that time, that is actually the all-time high right now, May 2015. The S&P 500 had come back 267%, nearly triple from the bottom. And with some basic knowledge and some, using the tools to analyze the market and listen to the story that it's telling, I say you can bite back, right, if the market's taking a bite out of your account. I think you can make great returns, and you can do that without taking crazy risk. So having some fear of the market is completely rational, especially if you've been bitten. If you don't have some good knowledge, if you don't have a strategy for managing your investments, and if you don't have a plan to manage risk. This is so important, having a risk management plan. But you can overcome fear and even participate and make some really good profit if you got some basic knowledge, if you got a strategy for managing your investments, and you've got a really clear, I say, statistical and math-based approach to managing risk. So I'm going to show you some of these things real quick. Just some suggestions, some stuff that works great for me. So let's look about some basic knowledge about how price moves. Again, I said, price movement is the reality. All the news, all the information, it matters, but what really, the synthesis of all of that is price, how it plays out, right? News stories, headlines, they talk dramatically about what has happened, right? And their job is not to help you trade your account. Their job is to get some eyeballs onto their article. So they often, dramatize what's going on, right? And particularly lately with what's going on in the market, right? But I say the market actually told us what it was going to do. Back before that big decline happened in 07, 08, or as it was happening, and then the recovery, price actually signaled that it was going to go down and then it was going to go up. And it's done that recently too. I'm going to show you some live charts here in just a little bit. But let's look back at these big moves here. First, I use two really, these are my two main tools that I use to analyze charts, whether it's index charts or individual stock charts. And they work on futures, they work on Forex. But I use Elliot wave theory. So Elliot, you know, he was back in Ralph Nelson Elliot. He worked back in the 1930s. And he said that he thought that there was what's called collective investor psychology or crowd psychology, and that the market moved between optimism and pessimism in natural sequences or waves. So we hear, you know, Elliot waves. Okay, and in Elliot's model, prices alternate between impulsive phases or corrective phases. And I've just seen this to be absolutely true. Not all charts fit an Elliott wave model, but when they do begin to fit, then you can begin to project what's going to happen next with a really high degree of probability. Okay, and these waves are what's called fractal, meaning they appear at any level of magnification. You can see them on a monthly chart, on a weekly chart, daily, or on a 2-minute chart. So you get these what are called waves inside wave. If you're in a big impulsive wave that's happening on a weekly chart, you could still have a corrective wave happening on a daily chart. I also use Dow theory. So Charles Dow, you know, he was working around the turn of the last century. He founded the Wall Street Journal. He co-founded the Dow Jones Company. And he had two, you know, this is a simplification of Dow theory, but he said, stock prices quickly incorporate new information as it becomes available. And once news is released, prices change to reflect new information, and that trends exist despite market noise. They might move temporarily in the opposite direction, but the trend will resume. Okay, so let's just look at pictures. Maybe that'll make it a little easier. So here's Elliot's model, right? And he says waves move in five wave sequence, right? And the big one, so it's wave, you know, 1, 2, 3, 4, 5, right? Wave 3 is the really big impulsive wave, and that's where most of the profits are going to be made, right? These ones pulling back are what's called corrective waves. So the ones going up are impulsive, the ones coming back are corrective. Okay, wave 3 is the big one, and if we can see a clear wave 1, 2, 3, and 4, we can really begin to project that wave 5 is going to happen, and I do that a lot. So Dow theory, so just making a picture of what Dow said, is that we have a trend, and this is on the left-hand side, a bullish trend. And he said, you know, it doesn't move in a straight line, that it moves in a sequence of higher highs and then higher lows. So, you know, we make a move up, we pull back a little bit, we make a move up, we pull back a little bit. As long as this pattern isn't broken, that trend is still intact. As long as we don't go, you know, if these higher lows don't go below the previous higher low, then we've got an uptrend still in place. Downtrend, same thing. Downtrends are a series of lower lows, lower highs, lower lows, lower highs. And as long as that pattern's not broken, then the downtrend is still in place. And feel free to type in questions as we go, and I'll be happy to field them if anything's not clear. So Dow theory, remember higher highs, higher lows, higher highs. As long as that pattern's not broken, we have an uptrend in place. As soon as the pattern is broken, like you can see it is right here, then there's a really good chance that that uptrend ended. And you can see here we put in, rather than a higher high, going to make a new high past that one, we put in a lower high, and then we came and took out this low. That's a kind of a warning sign that that uptrend is ending and that bearish trend might be beginning. And the same thing with the downtrend, right? A series of lower lows, lower highs. When we take out that last high, we start putting in new highs, there's a really good chance then that an uptrend is beginning. And you know, these can work together, both Dow and Elliott. You can see here's the Dow or the Elliott wave thing laid out on the top. And if you look down here at the bottom, right, each of these impulsive waves and corrective waves have these higher high, higher low sequences that Dow talks about. You can see when it turns, new lows are put in, and then when it turns again. So using these together has really been valuable for me. So here we look back again at the market. I showed the S&P 500 chart, right? So back here, when the big recession started, when the big downtrend started, that ended up going down almost 50%. Look at this pattern, right? The market had been going up, put in higher highs, higher lows, higher highs, higher low, higher high. Ooh, then we put in a lower high. And then we took out this low and we took out this low. That was a clear warning sign that the trend was turning. Without any other indicators, we can look at this price pattern and go, wow, this looks like it's turning. And it sure did, didn't it? It went down 50%. And then after 2009, we went down 50%, 49 point something percent. And look, at the bottom, we went in, we put in a higher high, a higher low, and we broke through that high. This analysis technique alone right here gave us a really strong clue that this downtrend was over and that a new uptrend was starting. And this one went on to go up nearly 300%. What was it, 296%? From the low of 2009 up till May of 2015. It went up 3x, right? And that pattern was unbroken the whole way, higher highs, higher lows. So that's pretty strong stuff, I think. So let's look at some charts from last July and last December. So here's a live chart. This is the Dow Jones Industrial Average. And I'm going to get my handy pen out. I'm going to use yellow. If you look through, the market last year, last spring and summer, from like March through June, stayed here in this channel, right? It just stayed there in that channel, and it was awful, right? Chris is asking, is this taken from daily or weekly? I am on the Dow daily chart right now, Chris. I'm not sure if you're asking about this current chart or the last one. So anyway, we're on the Dow daily here, and from like March through June, it was just terrible, right? It was hard to make profit if you're a position trader or a trend trader, and the market sits there in channels. But then look at this. We broke out of this channel. We went down to a lower low, a lower high. This did not go above this level here. All right, and we put in this series of lower lows. And back in late July, I published in my newsletter, I said, hey, it's starting. Remember, we're at the end of a 6-year bull run, right? And it's inevitable that it's going to correct at some time, right? So then we started seeing this sequence of lower lows, lower highs. So when this next one was put in back here, I published to my subscribers in my newsletter, and I said, the correction is starting. And then to my stock pick subscribers, I started providing short picks. And we were short several stocks all the way down here. And we made some really, really nice profit on that. We made some really, really nice profit on those short plays. We were short Goldman Sachs, Caterpillar, Ingersoll Rand, and we were playing those with some put options, just keeping it really, really simple. And we did really, really well. Now we had this pull back up. And again, this I said back then, hey, the bear market has started. But these pull-ups, right, on the longer term time frames are totally normal. So we went in, we put in a high, we put in a higher low, we took out this high. So okay, it's retracing a bit. Yeah, not a problem. So we had this pull back up, and then guess what? It started again. It started again. Thank you, Chris. It started again, and we put in, we put this low, we went up, right? And I actually drew a trend line at this point and said, hey, here's a trend line. If we go above that, then we're going to probably go maybe head on to new highs, but we didn't. We went on to put in a new low here. Look at that. And on December 19th, I again published to my subscribers and said, okay, it's starting again. And we started going short again. And we've been riding this down. We are still short. And we're short. We went short on Abbott Labs. We went short Goldman Sachs again, Apple, emerging markets ETF. We're still short China through an ETF. And it's we're booking some really nice profit. So as the headlines are screaming about the bloodbath in the stock market, well, it depends, I guess, on what side of it you're on. If you're on the right side of it, not so much, right? So that's really a look at what happened last summer and what happened right now, what's happening right now. And again, just using these basic tools that I covered without any other indicators. Now you see I do have some indicators on here. I use the Applied Reality trading software from Traders Coach. I've got the optimum wave locator, precision trend filter, I got these pyramids. Super helpful in helping me analyze the trends, analyze the waves, manage my trades. But just analyzing this price action and the story that it tells gave clear indication about what was going to happen next. And in terms of a forecast, where's the market going from here? Well, let's look at this. This is the Dow. Let's look at it on a weekly chart. So remember, we've been in a bull market for 6 years. We've got super good evidence that the bear market is beginning. This low from last August, there's such a high probability that that low is going to get taken out. And in fact, my projection is that we're going to retrace. Now, on this weekly time frame, this move up here is an Elliott wave 3. That's an impulsive Elliott wave 3. And so the next wave is going to be 4, right? And 4, the statistics, the probabilities, that have been proven over time is that 4 is going to end in a Fibonacci retracement zone from 38.2% to 61.8% retracement from this high, And so that gives us a Dow price target for wave 4 for this correction of 14,429 down to 12,003. And it can go deeper. It can certainly go deeper as well down to about here, which would be below 11,000. And so knowing that, using some Dow theory, using some Elliott wave theory, we can be positioned for that. There's no reason to sit there and go through a 30 or 40% correction and lose that money, right? And the really good news is we can make money. The market goes down more quickly than it goes up. That's kind of a time-tested fact. In fact, let's bounce this to a monthly chart just for fun. And look, here's the .com crash, right? Look how much more quickly that went down than the up, right? Here's the build up to the Great Recession of 07-09, right? Look how much more quickly it came down. Look how long it took. It took 6 years to get up to the high. So if history is any indication, right, these down moves are faster and they're more dramatic, and we can make some really nice profit here, and we're doing it right now. And you don't even have to go short. You don't have to trade options if that's not your thing. There are things you can do. There are things you can trade to go up when the market goes down. Like let's look at gold. This is the gold ETF, right? Look at this pattern on gold. Now, most people know that gold has an inverse relationship to the stock market. It's not a perfect correlation, but it's a pretty strong correlation, that when equities go down, gold has a tendency to go up. But what do we see happening here on this gold chart? I drew in these purple lines just to mark a channel that it had been sitting in, late fall into the beginning of this year. And look how it's broken out of this channel. And you remember this pattern that I talked about, right? We're looking for higher highs, higher lows, and we want to see a new high. If this gets taken out, if this high gets taken out, I think there's a really high probability that gold is heading up, that this long downtrend that it's been in as the market went up is about to reverse. I really want to see this get taken out and prove that that uptrend is underway. Let me get rid of these marks on here, and we can look at this on the actual gold contract. Get the right symbol in, Dean, and you'll be authorized for it. Okay, same patterns here. This is the actual gold contract, right? So this is showing the futures amount, the per ounce level of gold. So this blue line, 1113.13. If gold gets above that price, where is it going to? Well, let's take a look here on the weekly chart. Same way we did the indexes. Now this is a wave 3 down, and we're looking for a wave 4 correction, and we're looking for that wave 4 correction up into this same zone, 61.8 to 38.2, which would put gold at 1347 to 1532. It won't go straight up, but if it busts through this line, right, then we're going to get higher highs, higher lows, right? And over time, expect to end up in this zone somewhere. So that's, there are gold ETFs, there's gold mutual funds. You certainly don't need to listen to the guys on late night cable TV ads talking about buying bullion and coins and specialty gold IRAs. You don't need any of that, right? There's good mutual funds, there's ETFs, that kind of stuff. Gold mining ETFs, gold mining mutual funds. So good opportunity there to get into something that's going up as the stock market's going down. All right, let's go ahead and get back to my presentation. Keep me on track here. All right, we looked at some live charts. Get rid of my pen, get my cursor back. All right, so let's talk about a strategy for managing your investments. I talked about how to, just some knowledge of the market and how price moves, how to make some predictions, right? Here's an individual stock. So the individual stocks tell a story just the way the major indexes do as well, like I looked at. So this is a stock chart for Tesla, right? And if you look here, same kind of deal I was talking about. This massive uptrend signaled that it was going to start with this higher high, higher low, and a breakout. And it initially broke out of a pretty narrow channel here. And then it went on to put in a sequence of higher highs, higher lows, higher highs, higher lows. And the way we manage this trade, a trend like this, is to take our entry once a new high is put in. So we take an entry at this line, right as a new high is putting in, and we put our stop below the previous low. And then we simply trail the stop up. So as new highs are put in, if this high is put in here, I would trail my stop to this previous low. I'd leave it here until this high is put in, but then I trail my stop up, right? I trail my stop up. And there certainly is reason to scale out and take profit along the way. But we want to leave, I like to leave at least a third on for the full trend and wait for the pattern to break. And up here you can see it broke, right? It pulled back and then it had a lower high and then it put in a new low. And that's where our stop would have been, right? We would have got stopped out. And what an excellent trade, right? An entry down here at about $50 and getting stopped out at like 170. You really can't complain about a trade like that. So that's how we like to manage the trades once we're in them. And this applies, not just to bigger stuff like Tesla, but here's one. This is a small cap biotech CIRS. This is actually a trade we were in. My subscribers that I publish this for them, right? Again, higher high, breaking out of a channel. We take an entry there, trail our stop up to the lows, and we eventually get stopped out, right? So we got an entry here at $1.50. We get stopped out here at about 275. Those are small prices, but that's a huge price increase percentage-wise. So pretty nice trade. So let's look at a couple of my current positions that I'm in right now. So we're on a weekly chart. Let's get this back to daily. Okay. I said we were in MCHI. Let's look at that one. So this is awesome. I love looking at it because it's fun. So really clear, this is the Elliot, Elliot wave 3 coming down right here. You see it's the most dramatic, If you want to know how to spot an Elliot wave 3, my software helps, but it puts a pink dot on there. But it's just the biggest price move on the chart. There's nothing complicated about that, okay? Then there was a very clear correction back up into this magic Fibonacci number of 38.2 to 61.8, a perfect wave 4 retracement. And then lower lows, lower highs, lower lows, showing that this next trend is underway. And we went ahead and we went short here at this cyan line at 45. Our initial stop was up here at the top at 48.92. We've now trailed our stop down here to 46.04. We've scaled out. We've taken profit on this one already at 39.77 and again at 38.04. Our target zone, just using Fibonacci extension lines, is down here 34.12 to 24.97. We've already got profit locked in on this one. We've scaled out. We've trailed our stop. As soon as we get another, pull up and then down, what am I going to do? I'm going to trail my stop down to here. And we're just going to keep going until this trend proves that it is over. So this one, we're in it right now. It may be a little late because these downtrends can end at any time, right? We got a target zone down here that it might make it into, but if it turns around, not a problem, right? We've got profit locked in already. So we'll just have to see how this plays out. But here's a current one that I just published to my subscribers Sunday. And so you're getting a free preview of what people are paying for here. This is Starbucks, right? Now Starbucks had an amazing Elliot Wave 5 move up, right? There's 3, the biggest move, right? Here's 4, quite a correction, but right into my zone. Wave 5 up. Now it looks like there's a new bearish wave starting, right? My indicators are helping me with that. I've got a red wave locator. I've got a red trend filter, but I've also got, sound like a broken record, don't I, here? Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, right? Now, I really want to make sure this isn't just a correction to this massive uptrend. So I'm saying if we get to there, if we take out this one more time, right, down at 56.15, we're going to be short this baby, right? And the target zone for that is here at 47.91, right? And I'll be going short that with put options. Again, I don't do spreads. I don't do the winged creatures, butterflies and condors and all that. I just keep it super simple. I just buy a put, and I give the specifics of the option contract, what month, what strike price, what premium I'm willing to pay to my subscribers. But so there's a freebie, right? Starbucks, man. If it goes below 56.15, we're short that stock. So there was a couple charts to look at. All right, risk management. Let's talk about that. So this is kind of the last thing. We said, you want to have some basic knowledge about how price moves. You want to have a strategy for managing your investments, for trailing your stops, and for scaling out, and then risk management. So this, to me, is this is even more important than being able to pick the right chart. Because you can be wrong. You can actually be wrong less than half the time, or be wrong more than half the time. And if you have good winners, and if you're using good risk control, you can still be profitable, right? And if you can get your win rate up, in the pretty high percentage rate, and you're using good risk control, yeah, it just really, really helps your profitability. So what we do, and again, my mentor Bennett McDowell, taught me everything I know about this. But what we do is we say we're only willing to lose 2% of our trading account on any given trade. And some people get confused when you say that and go, oh, that means you're putting 2% of your account into a position. And no, it's not that. We're only willing to risk 2%. And so we do that, right? We need to know what our account size is. You need to know the entry price of the stock or the instrument, ETF, and the initial stop loss price. And then you go through and you say, okay, if I got a $100,000 account, 2% of that is $2,000, okay? And so I'm willing to lose $2,000 on a trade, on any given trade in a $100,000 account. And then I do this math. I take my entry price, and this will be on a long trade, my entry price minus my stop price, and that gives me the risk per share. Right, so entry, if I'm going to enter at $5 and my stop is at $4, my risk per share is going to be $1. And then I take the maximum risk, which is $2,000, and I divide it by risk per share, and that gives me the number of shares to buy. So you can see a live example here, right? If the entry price is $4.99, the initial stop is $3.99. I take that $1, that's a difference $1, and I divide it into my maximum risk, $2,000, 2%, and it says, hey, I can buy 2,000 shares. And so I buy 2,000 shares, and my potential risk is $1 per share. If I get into this thing and it goes right into the stop, then I lose $1 a share, $2,000, 2% of my account. Now, again, if you do this, if your winners are bigger than your losers, so if if the max amount I'm willing to lose on trades is $2,000, if my winners make $4,000, I could be at a 50% win rate and be making really good money. Does that make sense to everybody? So for me, that's really important. Here's an excellent risk management article, more detail there. So I'm going to post a link. So again, I said Bennett McDowell has been my mentor. He taught me everything I need to know about risk management, a lot more. So I'm going to post a link to an article. This is a magazine article he wrote. It's free. You know, you're welcome to give it a try. So there you go. It's in the chat area. Maybe just give me a Y if that shows up for you. Make sure everything's good there. Chris and Greg are my active participants here. Everything good there? Okay. I was getting nervous, like, oh, please tell me I'm online still. Okay. So it's a free article from Bennett. He goes over it in a lot more detail. That's certainly worth checking out. Okay. So let me talk a little bit more about my stock subscription. So if you're interested in that, I showed you a couple of the trades. My results the last 3 years, so 2013, the market was just trending hard. It was awesome. We made 57.3% in the account. So on a $100,000 account, it made $57,000. In 2014, the indexes did about 10-11%. We tripled that at 37.4. And then we wrapped up 2015. The indexes were down just a bit, and we still made 28.63%, which, most of the year the market was just channeling. It was tough. And so, early in the year we made some good profit. We were a little flat through the middle part of the year, and then as the market turned down and we were ready for that, we made some really nice profits at the end. And then, so I offer this subscription. You get 1 to 2 stock picks every week. I'm buying these with my own money in my own account. I'm just sharing the trades. These are the best of the best. Most of them include option contract details, either on a long trade or a short trade. I just buy puts, buy calls. And I give an update. If I'm not hitting the wrong button, I give an update, throughout the week. If something happens, right, I'll send a quick update. It's like, hey, we're going to move our stop. We're going to scale out. We're going to do this. And each week, at a minimum, you get a report and says, hey, how's the trade doing? You get a video and a text written email. Talks about updates to the stops, where to scale out. The list price here is $97 a month. It's a good deal at that price. But for webinar attendees, if you subscribe now, I'll give it to you for $77 a month. It's a 23% discount actually, and you get a 10-day money-back guarantee. So if you just send me an email within the first 10 days. I tried it, I didn't like it, Dean. I'll give you a full refund, no questions asked, no hard feelings. So if you're interested in that, and again, within 10 days, you're going to get 2 weeks worth of stock picks. So you'll see the one I just showed you, the Starbucks, and there's another one, good one, sitting out there, and as well as the existing ones and all that. And so here's the link if you're interested in that. Here's a link to my stock pick subscriptions with the discounted price. And that's in the chat area there too. So that's really the prepared material I had ready here. I just want to walk through those tools, managing trades, managing risk, show you a couple trades. I think these techniques have been powerful for me, for Elliot wave, very simple approach to it, using Dow theory to see when the market trends are starting and when they're turning. Managing the trades by trailing stops, by scaling out, and using risk control. That stuff's been like magic for me, near magic. It's gotten me really profitable, really good, consistent results. So I wanted to share that stuff with you. I'll throw it open if anybody's got any questions before we head out, and be happy to take your questions. And then I'll hang out if you're hitting those links and you have any questions. I'll hang out here and answer any questions or solve any problems with the technology. But again, that's it. That's the material I had ready that I wanted to present. So I'm going to go ahead and stop there. Oh, initial T is asking, where do you see Netflix and Amazon going? I'll take a look at Netflix and Amazon for you. Happy to. Netflix. Yeah, so I've analyzed this before. So Netflix actually is still a little bit bullish. I'm a little skeptical of it. If it comes and takes out this low here, right, and it's sitting right at it, you can see it's sitting right there at that low. If it takes that out, then I'm a little worried that this trend ran out of gas. Now the Elliott wave projection, that was all wave 3 up from way back off the chart, pretty clear 4 down. So using the Elliott wave, it would say that the bullish target is up in here between 173 and 139. But if this trend starts down, particularly with the rest of the market going down, we've got a lower low, lower high, lower low. If that does that again, I'd be a little leery about yeah. So Netflix has earnings at Tuesday. That might turn things around or establish a downtrend. So probably want to sit and wait for that. But that's my take on Netflix. I'll look at Amazon. I guess you have to type it right, huh? So Amazon, yeah, so it's just made it into the wave 4 bearish correction zone. So I would not be going long on it yet. I would not be going long. I expect this downtrend to continue a little bit more, and then it could turn back up. You got to wait for evidence, though. You can't just wait for like a single bar kind of reversal thing. That won't cut it. So you've had a lower low, lower high, lower low. If it heads up, it just could be a lower high, lower low, resolve somewhere here, 569 to 488, and then start a sequence of higher highs, higher lows, higher high. That would be a point for an entry. We're a long way from that. So I would be neutral on Amazon right now. So that's my deal on Amazon. Expensive stock too, man. Even the options are expensive. All right. Yeah, thanks, T. All right. Chris is asking, on average, how many stocks or options would we be following? I give 1 to 2 picks per week, and the typical time for the trade is 4 to 6 weeks. So, the most positions we've had open at any time is about 8. I think we've got 5 or 6 open right now, and that's pretty typical. During flat periods, we'll start closing them out, have a few less. Active periods, we'll be adding a few more on. But between 5 and 10 would be the typical range. Okay, I'll just hang for a minute here, see if anybody's got any more questions or comments. Greg. Okay, Greg is asking, to establish a trend or a trend reversal, is the pattern of higher highs, higher lows the first thing you look for? That's a great question, Greg. The first thing I look for is, what was the trend before? What was the trend before, right? And so I look here at Amazon, and what do we see? I can scrunch this a bit, right? I can look here at Amazon and go, we've just had a really long uptrend, and I see a series of higher highs, higher lows, higher highs, higher lows, right? And I see the software here telling me, pink dot, hey, that's wave 3, okay? So after a really long uptrend, I really don't want to jump in at the mature part of a trend because they can end any time. So then I start looking for evidence of at least a corrective wave. And we got it here, right? We got a lower low, lower high, lower low. But I just look at the price pattern for a minute, Greg, before I really start trying to count waves or analyze higher highs, higher lows. I go, what's the big picture? What's going on here, right? And there's really, there's 4. There's 4 possible answers when I pull a chart up. First is super clear uptrend. The second is a super clear downtrend. The third is a channel where the market's been trading in a narrow range for an extended period of time. And then the fourth one is a complete and utter mess where it's just chaos, right? There's no pattern whatsoever on a chart. And I can't close that one down fast enough, right? I don't like to trade in chaos where there's no established patterns. Hope that helped answer it, Greg. Again, I'll just hang out, see if any other questions or comments come in. All right, going once, going twice. I think that's going to be a wrap then. Hey, thank you all very much for attending. This is fun. For me, it was a cool thing to do here on a holiday Monday on MLK Day. I hope you found it valuable, useful, interesting. One last question from Jerry. Are you concerned with earnings? No, I'm a technical trader, Jerry. So, the information in the earnings absolutely matters, but I'm really more interested in what the collection of trader investors trading that stock think about it. So I'm more interested in what they think about it. So I certainly don't, I got an MBA. I know how to analyze a earnings statement and all that balance sheet and all that stuff, right? I did that for so many years. I never found that it helped my trading a bit. So all of that gets distilled down to price pattern on the chart. So if there's an earnings announcement coming up, right, I may wait or at least have my, have that in my trading plan to go, if it's going to make a big jump, what would I do? And I want to have that figured out. I want my trading plan figured out before I get into the position. I don't want to make decisions based on emotions once I'm in. I want to have a strategy and a roadmap for what I'm going to do with the trade before I get into it. So if there's a big earnings announcement coming up or something like that, that may cause me to develop a strategy, but I could care less what the earnings statement says. Earnings statements, in my mind, having studied them for years, are some of the finest fiction in modern times. And that's not that people are, it's just there's so many ways to put stuff in footnotes, and, earnings have nothing to do with how much money a company's making, right? I'll just, at the end of the day, I can look at price on the chart, and that's what everybody thinks about the earnings statement. That's way easier than getting out my green eye shade and spending hours trying to figure out what the accountants were trying to hide. What is the art pyramid based on? It's based on higher highs and higher lows for an uptrend and lower lows and lower highs in a downtrend. And there's an algorithm that Bennett McDowell, who created the software, has about the ratio of momentum on the up leg versus the down leg, or the down leg versus the up leg. So these are, I call them special higher highs and higher lows, and they really are good. I use the pyramids. I use them for my stop levels, and I trail my stop up to the bases of these pyramids in an uptrend and down to the bases in a downtrend. How often do I publish the noted charts that you showed earlier? The ones in PowerPoint, Chris, if you're asking about that, if you're asking about, these, how do I get back there? Something like this. If you're asking about, yeah, there we go. Get the right. Something like this. I use these for presentations, Chris. So I don't necessarily publish, these kind of charts. Now for these, for the picks we're in, like I said here, one of my picks, MCHI, subscribers get to see this every week. So I produce a video every week and tell them what's going on with the trade. And if we're taking a new position like Starbucks, in the video I put the chart up on the screen and I explain to them why I've got that as a pick. And you see I got my annotations here, right? This blue line, I always use cyan as my entry. I always use red for my stop level and green for my target. And if there's an Elliot wave count, I usually mark the chart up and show, my wave count, my retracement, my extensions, all that stuff.